Milton Friedman, a towering figure in economic thought, fundamentally transformed the landscape of monetary policy in the latter half of the 20th century. Understanding this transformation is crucial for economic history enthusiasts and students, as it highlights the interplay between theory and practice in shaping global financial systems. Milton Friedman's economic theories, particularly his advocacy for monetarism, gained prominence during a period marked by economic instability and high inflation. His ideas provided a stark contrast to the Keynesian economics that had dominated policy-making circles since World War II. Friedman's central tenet was that monetary policy should be focused on controlling the supply of money rather than engaging in fiscal interventions. He argued that changes in the money supply have a direct, predictable effect on economic variables such as inflation and output. This perspective was significant as it influenced a policy shift that prioritized market-based solutions over government intervention. The theories expounded by Friedman suggested that governments should maintain a steady growth rate of the money supply and avoid trying to fine-tune the economy through active fiscal policies. He believed that inflation is always and everywhere a monetary phenomenon, something that could be controlled by disciplined monetary policy. Friedman's influence was perhaps most visible in the policies of central banks during the 1980s. The Federal Reserve, under Chairman Paul Volcker, applied a form of Friedman's monetarism to tackle stagflation, persistent high inflation coupled with stagnation in output. Volcker's aggressive tightening of the money supply succeeded in bringing down inflation, albeit at the cost of a severe recession in the early 1980s. Nonetheless, this period vindicated Friedman's belief in the efficacy of controlling the money supply to manage inflation. The adoption of inflation targeting by central banks worldwide can also be seen as a legacy of Friedman's influence. By the late 20th century, many central banks had moved towards policies that prioritize price stability, adhering to the belief that keeping inflation in check is vital for long-term economic stability and growth. However, it is essential to note that while Friedman's theories significantly influenced monetary policy, they were not adopted in a pure form. The complexity of economic systems necessitates a pragmatic approach, blending various economic theories to address specific challenges. Critics argue that a strict adherence to monetarism can be overly simplistic and doesn't account for the unpredictable nature of global economies. In conclusion, Milton Friedman's economic theories reshaped monetary policy in the late 20th century by shifting the focus towards controlling the money supply and emphasizing price stability. While his ideas were not adopted without modification, they provided a valuable framework that continues to influence central banking practices around the world.